We have all heard the phrase one step forward and two steps back to describe a situation where we feel as though we are going nowhere, or achieving nothing. R.N. Elliott's observations were that as the market progresses, prices tend to ebb and flow in wave-like moves. Impulsive, flowing moves would consist of 5 waves followed by an ebbing back, in a more corrective period where prices seem to struggle to get anywhere, and consisting of 3 waves. Each wave then develops within part of a larger cycle. The complete cycle is composed by those 2 parts, and each cycle is part of an ever-expanding matrix of interlinking cycles of various degrees of trend. Chart courtesy of Elliott Wave International. In the basic wave formation, impulsive waves are labeled with the numbers 1, 2, 3, 4, 5, and corrective waves are labeled with the letters A, B, C. Impulsive waves will gain a lot of ground, whereas in corrective waves, prices tend to struggle to get anywhere. Corrective waves are more of a sideways consolidation or range-bound move that occurs when the market wants to hold on the price levels that have been gained. It is important to remember that these charts are showing 5 waves up and 3 waves down as in a positive market, but impulsive waves can also occur when markets are declining. An impulsive move in a declining market will take the form of 5 waves down and 3 waves up. Elliott Wave Theory Quick Start Guide. TradersDayTrading.com. Impulse waves page. Impulse waves are powerful moves composed of 5 sub-waves that drive the market in the direction of the larger trend. Within the larger impulse wave, the 5 waves subdivide into 5, 3, 5, 3, 5 formations and are labeled 1, 2, 3, 4, 5. Waves 1, 3 and 5 are the impulse waves and are powerful, driving moves which are interrupted by the waves 2 and 4, which are corrective and consolidating phases, creating the wave-like structure. An impulse wave itself always subdivides into 5 waves to a lesser degree, so the important factor for an Elliott wave analyst in recognizing that the trend has reversed, is to be able to count 5 waves in the internal subdivisions of the move. Wave construction is always the most important factor in wave recognition, so let's have a closer look at the subdivisions within an impulse wave. Wave 1, impulse. First wave subdivide into 5 smaller waves and can be either slow and steady, grinding away and relentlessly moving against the trader convinced the previous trend is still underway, or they can be sharp and decisive, blowing those traders out of the water. First waves can also take the form of a leading diagonal, which involves an overlap of waves 2 and 4, but these must still subdivide into 5, 3, 5, 3, 5 structures. TradersDayTrading.com, learning about the stock market for beginners and how to start day trading successfully. Elliott Wave Theory Quick Start Guide. TradersDayTrading.com. Impulse waves. Wave 2, corrective. Second wave subdivide into 3 smaller waves and are often sharp and deep, retracing much of the gains of wave 1. Within second waves, many traders are still convinced that the previous trend is still in effect. Generally speaking, second waves will be very deep and are most likely to retrace much of the first wave if that was a slow grinding move. Very sharp and powerful first waves can lead to a very shallow wave 2. Wave 2s never retrace more than 100% of wave 1. If prices move beyond the origin of wave 1, it is a clear signal to the Elliott wave analyst that his analysis is wrong. Wave 3, impulse. Third wave subdivide into 5 smaller waves and are typically the largest and most powerful wave. These waves occur on high volume and are broad-ranging with mass participation as the new trend becomes clear. Wave 3s are never the shortest impulse wave and are the most likely to extend. Wave 4, corrective. Fourth wave subdivide into 3 smaller waves and are often very complex moves. These tend to be sideways and range-bound moves, frustrating bulls and bears. Wave 5, impulse. Fifth wave subdivide into 5 smaller waves and are distribution phases. These usually display a weakening of the trend in prices, breadth, and volume. They can be long and drawn-out phases as the market tops or bottoms, but at times they can be very sharp spike-like moves. Fifth waves can take the form of an ending diagonal and involves the overlap of waves 2 and 4, but they differ from a leading diagonal which can appear in the wave 1 position, in that they subdivide into a 3, 3, 3, 3, 3 construction. Elliott Wave Theory Quick Start Guide Traders Daytrading.com Corrective waves page corrective waves retrace part of the previous trend but never move beyond the origin of the previous impulse wave. In other words, wave 2 never breaks the origin of wave 1 and wave 4 never breaks the origin of wave 3. Waves 2 and 4 within an impulse, and ABC are corrective waves. The different types of corrective waves are a zigzag, flat, triangle or a combination. Wave structure labeling: zigzag 5-3-5 flat, ABC 3-3-5 ABC, triangle 3-3-3-3 ABCDE. Combination waves. Combinations can occur when a corrective wave has not met its price target or needs to extend in time. Typical combination waves are double 3s or triple 3s, where a combination of zigzags or flats are joined together by an X wave. X waves are three-wave corrective moves. Double 3s are labeled WXY, each of which can be a zigzag or a flat. W and Y are two three-wave moves connected by the X wave. Triple 3s are labeled WXYXZ, each of which can be a zigzag or a flat. W, Y, and Z are the three 3s connected by the two X waves. The final wave in a combination can also be a triangle. E.g., a very shallow double 3, WXY, could consist of a flat, ABC, for W and a zigzag, ABC, for X, ending in a triangle, ABCDE, for Z. Elliott Wave Theory Quick Start Guide Traders Daytrading.com Elliott Wave Triangles page. Elliott Wave Triangles. As with all Elliott Wave identification, the internal wave formation is the most important factor in identifying triangles in Elliott Wave Theory. Triangles subdivide into 3,3,3,3,3 and are labeled ABCDE. In other words, each internal wave subdivides into a 3. It is important to remember that Elliott wave triangles are not determined by shape. Contracting price action in a converging triangular shape does not necessarily mean that it is an Elliott wave triangle. A very common mistake we have found is that most of the formations that we see purported by analysts to be an Elliott wave triangle are not actually valid. We believe that this is through wishful thinking rather than through reasoned analysis. An Elliott wave theory triangle is a particularly special feature as they can only appear at certain points in the cycle. This means that they can be extremely good guide in confirming to the technical analyst where we are at that particular point in the cycle. The reliability offered by the price action following these patterns can lure to the analyst to see what he wants to see rather than what is actually there. What we see depends mainly on what we look for. John Lubbock, Triangle Positioning in Elliott Wave Theory. A genuine Elliott wave triangle will only appear in the charts in certain positions within the cycle. They always occur in a position prior to the final wave in a move or as the final wave within a combination as mentioned earlier. Wave 4B, wave X wave, final X wave in a triple 3, final wave in a combination. TradersDayTrading.com, learning about the stock market for beginners and how to start day trading successfully. Elliott Wave Theory Quick Start Guide TradersDayTrading.com Elliott Wave Theory and Fibonacci Number Series page 11 R.N. Elliott himself wrote that the Fibonacci summation series is the basis of the wave principle. So what is the Fibonacci series? The series is 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 100, and 44. Each number is the sum of the previous two numbers. E.g. 1 plus 2 equals 3, 3 plus 2 equals 5, 5 plus 3 equals 8, etc. If you compare the number sequence and refer back to the chart on page 6 of this ebook, you will start to get an idea of the relevance of Fibonacci within Elliott wave theory. Fibonacci ratios are derived from the sequence of numbers, and the most important one is of course the golden ratio, which is 0.618. The golden ratio appears in many forms throughout the natural world, and the importance of the Fibonacci ratios within stock analysis is very clear to see too. There are many ways to apply Fibonacci studies to technical analysis, and we also look for Fibonacci ratio relationships between the related waves in a cycle. Here are some common ratios to look for: wave 3 to wave 1 to 1, 1.618, 2.618, 4.236. Wave 5 to wave 1 to 0.5, 0.618, 1, 1.27, 1.382, 1.618. When one of the impulse waves extend, there are some common relationships to look for, and an example of this can be seen in these charts. Common retrace ratios for corrections are wave 2 to 0.616, 0.786, wave 4 to 0.382, 0.5 B waves, 0.5, 0.618, 1.00, 1.27. Wave 2s are often sharp and deep. In an ideal world they would retrace 0.618 or 0.786 most of the time. Wave 4s tend toward a shallower retrace and will often find support at the 0.382 level of wave 3. B waves are generally less consistent and tend to vary in length more. TradersDayTrading.com, learning about the stock market for beginners and how to start day trading successfully. Elliott Wave Theory Quick Start Guide. TradersDayTrading.com. Applying Elliott Wave Theory. Applying Elliott Wave Theory. As with any other form of technical analysis, it is essential to remember why you are using Elliott Wave Theory in your analysis of a chart. It is not our wave count that is the most important factor, it is always the profit or loss derived from using our Elliott wave analysis that should be the only thing that matters. Applying Elliott wave theory is only a means to an end, so it is essential that a trader does not get drawn into the popular game of trying to force his preferred wave count into price action in an attempt to be seen to get it right. Top 10 tips for applying Elliott wave theory profitably. 1. Always observe the Elliott wave rules. 2. Always consider the Elliott wave guidelines. 3. Always be quick to accept when your analysis is wrong. 4. Always use stops losses. 5. Always consider the alternative wave counts. 6. Always use Fibonacci in conjunction with your Elliott wave analysis. 7. Always consider a potential trade entry in multiple time frames before entering. 8. Always remember which time frame it is that you are trading in. 9. Always have a trading plan. 10. Always try to gauge current sentiment to evaluate whether it confirms the analysis. Human behavior is firmly embedded and reflected in the movements of stock market prices, so we must always endeavor to take a step back and try to separate ourselves from the crowd. This is best achieved by considering all current, valid wave counts and observing live price action to try to gauge which wave prices are most likely to be forming. Elliott waves evolve. These waves then evolve into larger waves, so it is important not to get too far ahead of ourselves by anticipating moves that may never take place.